What's happening, guys, and welcome back to our channel. If you've been putting it in your local bank, your return is unlikely to have increased. Regrettably, most banks continue to give a fraction of a percent interest on savings account. That's why skip your bank. These 7 options will make you much more money. Number 7. U.S. Treasury Securities. These assets not only offer a higher rate of interest than local banks, but are also regarded as the safest investments in the world. The principal and interest on U.S. Treasury securities are fully guaranteed by the United States government. Different types of U.S. Treasury securities exist, with the term of the instrument being the most important factor. Treasury notes, for example, are securities with maturities ranging from 2 to 10 years, whereas Treasury bonds have maturities of 20 to 30 years. However, Treasury banknotes will pique your attention the most. These are the short-term investments that last from 1 month to a year. They're not as liquid as a savings or money market account at your local bank, but they're far more short-term and pay a lot more in return. You can also sell them before their maturity dates if necessary. Treasury note rates have recently ranged from 2.36% for a month to 2.70% for a year. In addition to high yields, Treasury securities have an added benefit. The interest they pay is tax-free in most states. Longer-term securities have slightly higher interest rates. The extra interest, though, isn't worth locking up your money for 2 to 30 years. Treasury Direct allows you to acquire, hold, and sell Treasury securities. Number 6. Online savings. No one would have contemplated this possibility only a few years ago. Online banks would have been deemed too dangerous. In addition, most banks now provide internet banking services. So what distinguishes online banks from traditional banks? They don't have branches all over the nation, nor do they have the overhead expenditures and payrolls like brick-and-mortar banks do. Banks may pay significantly greater interest rates on deposits because they have fewer operational overhead. Online banks are becoming much more widely accepted now that they've been around for a few years. Why should you put your money in a web-based bank? Because the rates aren't simply greater than those offered by local banks. They're much higher. Ally Bank, CIT Bank, and Synchrony Bank, for example, all offer online high-yield savings accounts with rates of 2% or higher. And, despite the fact that internet banks are purely virtual, they're nevertheless fully liquid. You may transfer money in and out of them, as well as to and from other banks, and even use a network ATM to access your savings. To be on the safe side, perform a background check on any online bank to which you're considering transferring your funds. Find out how long the bank has been in business and whether it is FDIC insured. Number 5. Peer-to-peer or P2P lending. This is a one-of-a-kind approach to investing in fixed income securities. You can invest money in borrowers' loans using P2P lending services. The primary goal of the peer-to-peer lending is to eliminate the banker from the loan process. Instead, you, the investor, take the role of the banker. Your money is going into loans to specific borrowers. That's not nearly as dangerous as it appears. You don't truly fund a borrower's whole debt. Instead, you put your money into what are known as notes. These are the $25 installments of a loan. An individual who borrows $25,000 from a P2P network may have up to 1,000 investors, each paying $25 to finance his debt. As a result, every investor's risk in a single loan is reduced. It also allows you to spread your risk over a wide variety of loans. You may divide your money over 40 different notes with a $1,000 investment. You may also choose how much risk you want to accept. You may take a more aggressive approach by purchasing higher risk, higher yield loans, or you can take a more conservative approach by purchasing lower risk, lower yield loans. Number 4. High dividend stocks. We're about to delve into a risky technique of investing your money for better returns. Large dividend companies might lose value even if they offer high dividends. You won't want to invest any of your emergency funds in these stocks. However, you may invest a portion of your money in them to boost your overall savings yield. High dividend companies, for example, often pay 3 to 4% in dividends, with some paying much more. Dividend aristocrats is a group of high dividend equities that are considered exceptional. A dividend aristocrat is defined as a stock that meets the following criteria: be a part of the S&P 500, minimum size and liquidity criteria must be met. Have a minimum of 25 years of dividend growth in a row. The final point is especially crucial. While it is true that even high dividend yield companies can lose value, they can also gain value. And some of the equities with the highest long-term gain potential are those with a history of boosting dividends regularly. As a result, you won't only receive a high dividend yield, but you'll also have the opportunity for the stock to appreciate over time. Number 3. Bonds. Bonds are longer-term investments that yield a higher rate of return than savings accounts. It's also crucial to remember that bonds aren't risk-free. They can fluctuate in value much like equities. As a result, if you're going to invest in bonds, you should avoid specific issues. Investing in bond funds through exchange-traded funds or ETFs that are linked to indexes is a superior option. You'll receive a professionally managed bond portfolio, which reduces the chance of a single bond issuance defaulting. High-yield bonds and municipal bonds are the two types of bond funds that one chooses to invest in. In recent years, corporate bond rates have been low. Due to the increased risk of the issuing firms, high-yield bond funds maintain portfolios of issues that offer higher rates. They can, however, provide large profits on short-term investments. Over the last 12 months, the iShares iBoxx Dollar High Yield Corporate Fund ETF, for example, has paid a yield of 5.35%. States and municipalities issue municipal bonds. Although they pay lower interest rates than high-yield bonds, the interest received is tax-free in the United States. If you live in the state where the bonds were issued, the interest will be tax-free. Once again, the best method to invest in municipal bonds is through an exchange-traded fund or ETF. In the last 12 months, the iShares National Muni Bond ETF, for example, paid 2.46% in tax-free interest. Number 2. Mixed portfolio. This is a more creative way to earn a greater rate of return on your investments. You may build a portfolio that includes both stocks and bonds, but the emphasis should be on bonds. The aim is to combine the relative safety of bonds with the greater yields of equities. You could, for example, build a portfolio that is 80% bonds and 20% equities. If you want to be a little more adventurous, you might invest 75% in bonds and 25% in equities. This portfolio is riskier than CDs or treasury bonds, but it has the potential to provide larger returns. You won't only earn interest on the bond component, but you will also benefit from capital appreciation on the stock portion. It will boost your overall return over that of interest-only investments by at least a little. Number 1. Real Estate Investment Trust. You may invest in real estate instead of stocks and bonds if you choose. You may accomplish this by investing in real estate investment trusts, or REITs for short. REITs are investment trusts that invest in real estate. They're similar to real estate mutual funds. Commercial real estate, such as office buildings, retail space, and huge residential complexes, is where they usually invest. Some, on the other hand, focus on smaller projects such as home renovations. Others keep track of important industry indices. Online crowdfunding sites are yet another option to invest in real estate. This is where you put your money into loans or equity holdings in specific real estate transactions. Fundraise, Realty Mogul, and Rich Uncles are just a few of the crowdfunding sites available. Fundraise is particularly appealing since it's accessible to investors of all financial backgrounds. They purchase real estate, and you can get started with as little as $500. Do let me know your thoughts regarding all of this in the comments down below, and I'll catch you guys later in another video. Bye now!